In this video, which is really the last segment of this chapter, we are going to learn about how does the Federal Reserve control money supply. And so recall that we had learned in earlier videos that a money supply is given by multiplying the money multiplier with the bank reserves. And so the Federal Reserve can change the money supply by either changing the bank reserves or changing the money multiplier. And so this brings us to the question of how does the Fed influence reserves? You're familiar with one technique, but we'll talk about what the Fed does on a more frequent basis. So the first tool with which the Federal Reserve is able to influence the quantity of money in the system is called an open market operation. Okay, and an open market operation is of two types. The operation could be a purchase or a sale. Okay, now what is it a purchase or sale of? It is a purchase or a sale of U.S. government bonds by the Federal Reserve. Okay, this is important. Who is purchasing or selling these government bonds? It is the Federal Reserve. So whether it's a purchase or a sale, it's going to have different effects on the amount of money or the quantity of money in the system. So let's take a look at what happens if there is a purchase of U.S. government bonds by the Fed. So let's assume here is the Fed and they are transacting with banks. Banks hold U.S. Treasury securities or U.S. government bonds, so they can enter into this transaction with the banks. Now the Fed could purchase Treasury bills or U.S. government bonds. So they could buy or purchase Treasury bonds in exchange for, obviously whenever you buy something, you have to give money in return. So the banks are going to receive this money, and banks are going to have more liquidity in their balance sheets, and banks would be able to make more loans. Okay, and as they're able to make more loans, we've seen that money supply in the system would increase. Okay, so one way the Federal Reserve is able to increase money supply is by doing what we call an open market purchase. Now, a sale would look different, where the Fed again interacts with banks, and this time the Fed is selling Treasury bonds to the banks. So Treasury bonds are going towards the banks. Okay, so they're selling Treasury bonds in exchange for some money. And so since money is flowing from the banks to the Federal Reserve, banks have less liquidity and are able to make less loans. And this would decrease the money in the system. Okay, so depending upon what the banks want to achieve, whether it's an increase of money in the system or decrease, they're going to carry out open market purchases or sales. And this is the most frequently used tool for monetary policy, for conducting monetary policy. And this happens almost every day. So that was the first tool, which is called open market operations. Let's take a look at the second tool of the Federal Reserve, which is either trying to change the discount rate or doing some sort of an auction. So the Fed could make loans to banks, increasing their reserves. One way the Fed is able to achieve this, so the Fed can make loans to banks. This is sort of the most infrequently used tool of monetary policy, but it's still effective. The Fed can make loans to banks, increasing their reserves. So in the traditional method, which is using the discount rate, the interest rate, the discount rate is basically the interest rate on loans that the Fed makes to banks. Okay, so if Bank of America needed a loan, it could go to other banks. It could go to Citibank, it could go to Chase, or some other banks, or it could go to the Federal Reserve. Usually that's the last resort because the central bank or the Federal Reserve is the lender of the last resort. So this is, again, an infrequently used tool. But imagine if the interest rate that the Fed charged was high, then banks would not take out as many loans, right? So banks would not take out loans or decrease the amount of loans that they require, and so this would result in a decrease in money supply. But if the Feds want that money supply should increase in the system, then they could decrease this discount rate and banks would borrow more. Banks would borrow more and therefore be able to loan more funds out, thereby increasing money in the system. So it really depends on what the Fed wants to do with money supply in the system. But recently, so this is sort of the traditional method, and the newer method is something called term auction facility, in which the Fed chooses the quantity of reserves it will loan. So they're going to fix a dollar amount for how much they want to loan, and then banks would bid against each other. For these loans. This method was used a lot in post the Great Recession and even during the Great Recession. So this is sort of the more unconventional methods. The third tool that you're very familiar with is called the reserve ratio. Again, the reserve ratio is just denoted by R, which is the ratio of total reserves to total deposits in a bank. And this is inversely related to the money multiplier, right? So, which is to say that money multiplier equals 1 over R. So if the Federal Reserve wants to increase money in the system, it could decrease the requirement, the reserve ratio requirement for banks. So if the requirement was 20%, banks were required to hold 20% of their deposits as reserves. Now the Fed could decrease that and say, well, banks only need to hold 10% of their deposits as reserves. So if reserve ratio goes down, then there are more funds. Banks have more funds available to make loans, and this would increase money supply. And the flip side here would be that if the reserve ratio was increased, banks are able to make less loans, and this decreases the quantity of money in the system. Okay, but then there are some problems that the Federal Reserve faces in controlling the money supply. So while it can implement open market operations, it can change the discount rate or do auctions or change the reserve ratio, it still has issues in being able to control the money supply completely. So one issue that arises is from households. So recall that application that we did where you had that $50 note. Now you could hold that $50 or you could deposit it in the bank. So if households hold more of their money as currency, banks have fewer reserves and make fewer loans. Thereby decreasing money supply. Okay, so households also can control money supply in this way. So you want a well-functioning banking sector so that households are not trying to be or not trying to not engage in the banking sector. Okay, now banks also can do something similar where banks, even though there is a reserve requirement R which says, well, you should hold 10% of your deposits as reserves, banks can choose to override that and hold more reserves than required. Or in other words, they can hold excess reserves. Banks can, so beyond the requirement, they can hold excess reserves. Which is to say that they can hold more reserves than required. And if they do that, then they make fewer loans. And money supply would fall again. So the Fed can compensate for household and bank behavior to retain a fairly precise control over the money supply. So they have all of these different tools that we had just described to affect money supply, but still they can't do so perfectly. Now, in the United States, we can see what is going on with excess reserves. So we can type in here excess reserves and see whether the US in the banking sector, have banks held any reserves in excess of the requirement by the Federal Reserve. And what do we see here? So on the x-axis we have time, right? So you can see that excess reserves were pretty much zero all the way from 1985 until 2009. But ever since 2009, excess reserves have remained positive. So the banking sector has chosen to hold more reserves than the requirement of the Federal Reserve. Okay, and the thing is that the reason why this is happening is because since 2008, the Fed has paid interest on reserves banks keep in accounts at the Fed. So there is that caveat to why this has happened. Also, banks have been a little pessimistic about lending too much out because they